Charlie, good morning. How are you?
Good morning, Jeff. Great to be here.
You got a little more dressed up than I did.
Roles are reversed. This is
I
VC and
have my
entrepreneurship.
patented go long shirt that I wear for these, so it gives me an excuse not to get dressed up.
Yeah, I'm like a mid-aughts VC. This is what you all used to wear, I think, back in
There
the
you
day.
go. There you go. We used to call that the Silicon Valley tuxedo, the sport coat with the collared shirt and the jeans and running shoes. Hey, I know we only have 30 minutes, so I want to be conscious of your time. Congrats on the financing. We're thrilled to be an investor in Convex. Maybe for folks that don't know you or the company, which I'm guessing prior to the financing announcement, maybe was a number of folks in the tech community because you guys are in sort of an unsexy space, if you will. But talk a little bit about the company, why you started it, and maybe a little bit of your background. Folks always love to hear, sort of the entrepreneurial why. What gave you the itch to start Convex?
Yeah, absolutely. And let me just start off by thanks for having me and grateful to be in the portfolio at GGV and fantastic amount of support so far and looking forward to working together for many years to come. I'll start with, my background and how I led to found the company and then sort of what we do and why we're so excited about it. And I think GGV is as well. Many folks know I grew up in the Detroit area, which is not a hotbed of SaaS startups, but is the proving ground for many in industrial business. And my family had a variety of industrial companies, one in wiring, another one actually in the HVAC and plumbing space. And you could think of that sort of markets in my blood. And I bring that up because I think it gives you a lot of empathy and appreciation for both the scale of these industries, their importance to the economy, and then the people who work in them. And I think to build vertical software, you need to have a deep appreciation of those. And I made my way out to the East Coast for college. And this is about 2010. And afterward, ended up in New York City working in energy markets, actually as an analyst for a fellow named Michael Levy at the Council on Foreign Relations. He was a former physicist, very technical guy. And he really opened my eyes to buildings, the built environment, which is a very sexy term now, particularly with the reemergence of climate tech. But back then, this was like a backwater of the economy, as you can imagine. And I worked for him for a number of years. I wanted to go back to school, ended up at a dual degree program at Harvard and MIT. At MIT, I was mostly studying finance and the business program. I think it's a great sort of skill set for an entrepreneur if you're non-technical like myself. Lucky to have two technical co-founders. And at Harvard, I was working on electricity market design, which is basically where the grid meets buildings, which is very relevant for commercial services because all of our customers sell, install products and service physical structures, which I'll talk about. And I was obsessed with starting a company. I really want to start a company. Cambridge is a very exciting place. People are like curing cancer at MIT. And so the bar is very high of like the things you can work on there. And I had a couple ideas. I was like kicking around ideas. I was in all like the accelerator classes, have some great professional mentors from that period. And then I did what basically all software entrepreneurs do is I work to go work at Goldman Sachs, of course, in San Francisco, joking, but really grateful for that opportunity. And was there for a year and a day, had the opportunity to see sort of growth stage, extremely successful SaaS businesses up close, see their P&Ls, meet the management teams. And this is right about when Procore and PlanGrid were really taking off. And I still really wanted to start a company. And so I was kicking around this idea and I came back to physical structures, to buildings, to my family's business, to commercial services, which is the market we work in, and became like literally obsessed with this idea. One of my colleagues at the time was like, you're spending a lot of time thinking about this. I think you might want to go do it. To which I said, do you want to do it with me? And this is Blake Muehlmester, my co-founder. And if initially he said yes. And so I said, okay. And I quit my job on a Sunday night and they were very understanding because I was going to go start a company. And he said, oh, you're actually going to go do this. And I said, yeah, I'm going to go do this. And you have sort of 3 weeks to decide if you're going to be my co-founder. It was a bit of an ultimatum and he jumped on board. We bootstrapped the business for 6 months. We worked out of his garage in San Mateo, raised zero money, including friends and family money. And then met our third co-founder, Brand Dement, software engineer, had just had a major exit at Brightroll. And we got to building code and then were eventually accepted into Y Combinator in the fall of 2019. So it was sort of a 6 month to a year stretch of prototyping, listening to customers, kind of chewing glass of that early stage startup life before we came to anything, resembling product market fit and certainly before YC. So that's a little bit about sort of where we came from, where we're going. Happy to share more about the core business.
I think folks are always interested, like in that 6 month window, what did you guys spend time on? I mean, I always tell folks when I started my second company, we actually did the same thing. We went and got 3 customers and they were big customers. People are always like, what did you sell them? I go, well, we kind of made it up as we went along, but I'm curious to hear what did you guys do in that 6-month window? Because I think people always hear the legendary, we started in a garage or we started in somebody's house, but they're sort of like, so what did you actually do for that 6-month period before you enrolled in YC?
Yeah, we did two things. One, structured research, which is like nothing more than talking to people, but talking to the right people. And that takes a ton of hustling. And then two, prototyping. So we were writing code. We had a prototype of a product we thought we were going to build, but we mostly had a lot of wireframes. And so we were doing sort of rapid prototyping of wireframes. So when we went to the meeting, we could show them something that they could buy potentially and get their feedback.
Some demo,
people, yeah,
hard-coded demo.
Yeah, it was very 2D in that sense, a piece of paper. And on the structured research side of things, you really have to hustle to get people to pay attention to you. And so if this is live and recorded, I'd just like to publicly apologize to my entire professional social network from like 2018 to 2019, because we called in every favor we could to get in front of people. And we would cold call people. We cold walked into our customers' offices. We would just show up and knock on the door and see if they would talk to us. And you kind of need that with the thoughtfulness around product development in that window, or else you just spin in circles and you just never really get any traction.
Yeah. Okay. So you apply to YC, you guys get in. What was that like?
A whirlwind. I think we were expecting something a little more low key, frankly. And the experience instilled in us, I think, two things. One, set clear goals. They're very big about this. This is when YC was in person. You would go down to Mountain View in a circle and they would scold you if you did not meet your goals. It was a very effective way to scale. They wouldn't put that on the website, but it's true, and in a very appropriate way. And then secondly, it sort of put us more on the map, no pun intended, just in terms of this is a really big venture scale market. At the time, I think there was a lot of questions about that, and they had backed PlanGrid. And Tracy and Ralph, the founders, are investors in Convex a couple of times over. And so YC had that sort of association with PlanGrid, and we could ride the coattails of that because at the time people thought we were, again, market was too small. This isn't interesting. And so that was something we were able to kind of glean from them.
And did you mostly stick with the thesis behind the business through that period? I mean, because I think one of the things that's always interesting for us is I always tell founders, hey, everybody talks about the pivot in the media. I'm like, well, all businesses pivot. It's a series of pivots, right? As you learn more about the customer and you move up market or down market. Yeah. How did it evolve over that first, that kind of first 6 months? Then you go through YC. How did the business evolve? And maybe we can get to where you are today.
Yeah. Our aperture definitely widened. I had a sense that this market was $1 to $2 trillion globally, probably 400 to 500 billion in the US alone, and that we could build a number of software products there. We didn't have a multi-year roadmap. We still only have really an annual roadmap. I think that's a healthy thing. And YC was very good at sort of broadening our aperture of how big could this business get, because you're being compared to DoorDash and Stripe and Airbnb and so on and so forth, Coinbase. And so that was really helpful. And then Kevin,
they've been in a few good companies along the way.
yeah, just a couple. Yeah, it's a pretty good model they got down there. And I give a lot of credit to Kevin Spain, who led our Series A at Emergence. He met with me right after YC. He was an investor in Viva. They had led ServiceMax. He had a really good sense of these industry cloud businesses. And he said, Charlie, I think you need to think even wider about the suite of products and services you could offer. And that was in 2019. And so we didn't publicly share that, but that was sort of what we put in place a couple of years ago as we were expanding through the business. And yeah, whether you describe them as pivots or someone said like it's a maze and you're trying to find more TAM as you go and build more product, whatever the analogy is, we're always kind of expanding the aperture.
Yeah. And Viva, by the way, I had to check, $48 billion market cap company that kind of flew under the radar. It's actually based in Pleasanton where I live. So I knew about it, but it's amazing how few people know about Viva, and Emergence famously was the only investor in Viva. So not surprised that they got your story immediately and said, we'd love to do this. Fast forward, you raised that round with Emergence, obviously good fit with a firm that understood your model and the direction you wanted to head, which I'm always a big fan of. What happens next? What'd you guys do after you raised the A?
COVID happened. We were preempted our A in February of 2020. We closed it March 18th of 2020.
And you must have been like, thank God.
Yeah. I mean, and Kevin's a fantastic long-term thinker, and they're just a really fantastic group of people, like individuals at that firm. But it was a rocky time, not really for our business. I'll share more about that, but just everyone was freaked out, as you recall, personally worried about their safety. And so we got to work, spent most of our time with our customers, making sure they were okay. We didn't have huge churn. And as you know, we really 4X the business last year, driven by what I think is a secular change in our market around COVID, not the sort of boom and bust around some of the remote work themes that have sort of ebbed off. This is really a change in the way our market works around things like indoor air quality, around tracking people in physical structures and buildings, and making sure that you have the sort of security in place of who's vaccinated, who's not. These are not going away. And so we really got back to work. We didn't announce the round. I think we've historically, as you alluded, been a little shy of the press. And by shy, I mean really focused on the customer. And so we spent a lot of time with our customers and got to building over the following year.
Mm-hmm. And so fast forward to today, you raise a Series B. Talk about what that process was like and how you, I don't know, focus the effort. I think folks just love to hear, you know, we all read the headlines about fundraising. Everybody's like, oh, fundraising is easy. I'm like, it's never easy.
Yeah.
You know, there's always some ebbs and flows. So maybe talk a little about what raising the B was like.
Yeah. Maybe a point on context and then a little bit on process. I think the context, what I read in the press is, oh my gosh, the market is so hot. Deals are being done in a day or two. And, you know, people are fighting to get access to these companies. I think that's true within a certain echelon of company and investor, but this is this is the top, like more than top decile. This is really like the top 1 to 5% of those businesses that have already raised Series A. If you look at our YC class of 195 companies, I think something like 10 have raised a Series B.
Wow,
maybe 10.
That's amazing.
Yeah, and
that's
one
great
of them,
context.
yeah, one of them's worth 5 billion currently, and you know there are many that that no longer exist. And so I just think you're getting increasingly rarefied air, and we're very fortunate to be in that because we have the metrics and the traction to prove that. So our business is very much on the process point, measured twice, cut once. So we spent a month putting together materials because we always try and look like a round or two ahead in terms of our process. And so we had full data room, full deck put together. I had my pitch mostly ready. And then we went out on a Thursday and signed the term sheet a little under 3 weeks after that with a very select group of people, and grateful to be introduced to you from Michael Wolf during that period. And it went very quickly, but I don't think that's sort of the norm. I think a lot of these processes take like 3 to 4 months, and that's a healthy thing, and that's okay. And I think from an entrepreneur standpoint, you should really earn these rounds in terms of what are the core metrics, how good is the fundamental business? If you abstract just growth away for a second, which is you need that, how good are the unit economics? How good of a software business is this going to be? And that's a lot of blood and sweat over the preceding periods between the financing rounds. And so if you can prove that with metrics like gross and net retention, with things like CAC payback, then you're in a really good spot. That's not the sexy stuff to pay attention to between the rounds, but that's how you get these things done, in my view.
Yeah, and well, first of all, the data point about 10 out of 195, I think, I mean, YC has as great a filter as anyone. I mean, I think that is representative of the market.
Yeah.
I mean, I would say, you know, you take 200 companies that were created or, you know, seed funded in Q1 of last year, this maybe raised a Series B. But the perception is that 195 have raised a B. So that I think is an interesting data point. And then your second point, it is funny. I've had this conversation with founders where they say, wow, the growth is amazing. I'm like, but there's still a bunch of things that we need to get right in this business for you to feel really good about it. He's like, absolutely. Mm-hmm. So when you go pitch investors, they're going to see that. Mm-hmm. And it's all tied together. And so you can raise capital when a bunch of the pieces of the puzzle still aren't there yet. You just have to be open about it and find people that want to build with you. I think that's an interesting part of the experience. And it's part of where we like to get to know people over time, right? Is because then we can sort of see them building, see them, you know, one of my favorite stories, we just announced a financing today for electric. I mean, we backed Ryan. A lot of the pieces of the puzzle weren't in place. Yeah. But, you know, we've been there for the journey and we've seen him build and we doubled down again. And I think that, you know, just in looking at what you guys have built, first of all, your data room, your setup for fundraising was, you know, very high because of your background and you sort of know the market. But I think the business is starting to come together in a way that makes it clear to people that there's something really powerful in what you guys are doing. How do you have you guys gotten to the point where you've started to build out territory? I mean, I think Series B is when folks start to get into a more complex go-to-market environment. I'm just curious how you're thinking about that. And in particular, any vertical software business, pretty targeted effort in terms of who you're going after. Can you just talk about what that looks like and how that might be different from somebody who's building a horizontal business?
Yeah, absolutely. And to contrast it, Convex day zero, go to market was yours truly, cold calling people and cold LinkedIn deals. Like we've come a ways. Yeah. I also had no sales experience.
You had a customer success too.
Yeah, and I did CS too. That was a certain era. And I would just say for any founders listening, like learn how to sell. It's really core to the business, and learn how to do it in a way that respects your customers. But to the go-to-market point now, we've gotten increasingly sophisticated. We really have three motions. We have a commercial segment, which is businesses over about 50 employees. We don't do anything in SMB. It's not our core competency. And I think one of the things about go-to-market is figuring out what you don't do well and avoiding that. So again, things like CAC can be in line. We have an enterprise segment. These are businesses that are not necessarily household names, but the contract values can be in the $100,000 plus range. It's a big market that we operate in. And then we have what I would call strategic named accounts. There's 40 to 60 of those. These are businesses like Siemens, Johnson Controls, and we have dedicated account executives. And each of the motions is a little bit different. I'd say the overarching theme is, unlike a horizontal business that can do a tremendous amount of paid acquisition, demand gen, sort of funnel generation where people are signing up with their credit cards, we don't really have that luxury. The flip side is we can generate very high ACVs, and our pricing is very high. If our customers are listening, I think we drive a lot of value behind that.
Right. A fraction of the value created.
Yeah. And we can talk about ROI as we think about it, but that leads to a very different motion. So most of our marketing function is around content, webinar series, product marketing, understanding sort of what we do. We're relaunching our website in about a month. And as opposed to, sort of funnels and click paths and things like that. And then the last thing I'd say around horizontal is, you versus vertical software is you really need to nail the use cases. You need to speak the language. You need to understand where the customer is coming from by each sub vertical in a much more detailed way than selling a product that, literally anyone can use. And I think that's really important. And I do believe you can still practice product-led growth. That's a very sexy term these days. I think you can do PLG in these markets when you still have a direct sales force, because you can sell individual offices and get sort of the word of mouth going within these big logos. And it's a great way to find product market fit. So that's a bit of an overview of the sort of the three segments we operate in currently. How did
you learn the point about knowing what you're not going to go after? I think is super important.
Yeah.
How did you learn that? Because I find as a board member, sometimes that's a big thing we need to help teams focus on is, particularly when you're going after a market category that's huge, you see a ton of opportunity. You've got a lot of ideas in your head. And the tendency is to say, let's go after 4 things at once, when in reality, you've got a limited amount of resources. How did you learn that? And how did you form that opinion?
One was external and the other was internal. The external was understanding, what is the data that we're receiving from customers in these different segments. Initially, we did sell pretty much anyone and their uncle the product just to see. And we were big on that. Like, forget this whole free trial stuff. We never did free trials. Everyone was a paying customer. And some of them, we learned were not the right fit. And we learned that through a tremendous amount of data, even in the early days, around usage patterns, around obviously retention, NPS, correlations between all of those, ICPs, who were the buyers, what types of profiles these businesses, and we translate that into the go-to-market. And so we learned that we shouldn't sell customers under a certain number of employees or a certain revenue figure, or we should only sell seat counts over a certain amount. And that was through just the data and the feedback. Internally, I think we looked at our core competencies too and said, from a founder or founding market fit team perspective, we're much more comfortable in, literally the boardroom of a Fortune 500 and those sort of sales processes, and bringing those deals across the line and explaining the value there in these larger, more complex deployments, akin to what even a consulting firm would do in terms of transformation. And so we thought our core competency was there, but it's a lot of listening to the customer and being real with yourself about basically mistakes, places where you shouldn't have been operating.
As you think about larger customers, how do you guys handle implementation, professional services, account management? I think that's one of the things that a lot of companies wrestle with early on. And the mantra from investors used to be, oh, don't do professional services, it's low margin, blah, blah, blah. I've always disagreed with that. I personally think it's a great way to build a relationship with a customer, get a lot of intel on what's working about the product. But how have you guys thought about that?
We have over-invested in it. At the beginning, it was very much the YC mantra, like do things that do not scale. The CS motion was insanely hands-on. I mean, we were doing one-on-ones with every single user we had. And actually the pricing supported that. We've since scaled that motion to more of that sort of pizza party model where you can have like 8 to 10 people with one CSM. We also hired really early on a fantastic VP of customer success that had been in the market 20 years, Roger Muckenfuss, and he has architected this entire sort of customer journey across all those segments. And in the named accounts, we have just really incredible CSMs. These people are business partners primarily. They're very quantitative, and they're also very good with the users. And that's sort of a triple threat when you think about taking a logo like we have in some cases from $50,000 in spend to $450,000 in spend. There's a lot of people in between there. And I think the great thing about CS, a good CS org, is also your product org in vertical SaaS. You can actually understand what do they want you to build next. We've not publicly announced another product that we're already selling. That came out of feedback from CSMs in the trenches on some of these bigger deployments. And as you know, if you have a leaky bucket in the enterprise, the whole thing falls apart. So driving retention in an extremely predictable way, forecasting predictable retention is really the lifeblood of this business. It's as important, I think, as forecasting sales. You need to have really good clarity quarters out. What's the GR going to be and how are we going to get there on a literal deal by deal basis, account by account basis. And we built that motion. And I'm really proud of what Roger's done there.
100%. And the public markets have figured that out. I mean, if you go back 5 or 6 years ago, most public SaaS companies didn't announce their NRR, NDR metrics. Now everybody does because the markets have figured out, wow, that's a superpower. If your existing base grows 10, 20, 30% every year, whew, you got
incredible momentum in these
top ones that are growing 30, 40. It's incredible.
Incredible momentum in these businesses. And yeah, I think we're gone the era where you could go public at like 97% net retention net. I think people are expecting 90% gross or 90% plus gross. And that's where we're lucky to be. And that's a real program to spin up. And it's a lot of hard work to maintain that and to serve our customers that way.
What's been the hardest part about being a founder and a CEO over the last 3-4 years? You left a presumably somewhat cushy job at Goldman. You could have done anything given your background. What's been the hardest thing for you as a founder and a CEO?
I think it's the thing that I also like the most, and that's simply motivating people. How do you do this at different scales? We're often motivating people, at least historically, with limited resources to achieve things that are on the face of it basically impossible. As you mentioned, if you think of the math of, again, how many companies get into YC, how many companies make it this far, the odds are like not great. Expected value basis as a pre-seed, company, not great. And so how do you get a team of people, some of whom who don't know each other, and particularly in this environment, who might not have met in person? We have our first offsite this week where we're bringing the whole company together. Most people have met, but not everyone. How do you get them to work, kind of hand in hand on some really challenging problems? And that's particularly true in the product development stage early on, where you're pushing features all the time. And there's a huge amount of pressure on our EPD team to deliver. And that's a constant challenge, but I just get a lot of joy out of that and making sure that people are enjoying their career at the company.
Yeah, you guys have built almost your entire business in a virtual. I mean, is the company going to be virtual for the long run? Is this the model, or how do you think things evolve from a work perspective? Because that's such an interesting. We're in our firm, we've got, I don't know, maybe 20% of our people have joined in the last 2 years in this new environment, but the other 80% knew each other and we're in the office together.
Yeah.
When you've built a lot of our companies, 80, 90% of the employees have joined in a virtual environment. I'm curious to get your take on what challenges that's posed for you and how you've thought about what that looks like going forward as a CEO.
I think it's actually a great advantage to be building in the middle of this. We don't have really legacy costs, stranded assets, if you will, or stranded ways of thinking about this. We had 15 people at the Series A. We had an office at 300 Brannan. We are now approaching 80 people. That's all been done during COVID. And so I think we've got a huge amount of flexibility about how we think about this. And that's a strength because we're bringing people into the culture and the values of the company that is, primarily remote friendly. We are still in a holding pattern about our long-term real estate plans. And I think that's also a healthy thing. Most people have realized that there's a lot of value about being in person, but we have this core strength that we can have great success with people remote, which gives us access, as you know, to increasing pools of talent in the US and globally. And so I think we'll continue to have, an in-person physical presence in multiple locations, but we're increasingly hiring people wherever the great people are, and we can ramp and scale them. And that's also what you're asking is how do you onboard people in these different roles and get them productive. And I think we have a huge competitive advantage in that versus a legacy company that had, a couple hundred employees in an office before COVID and only knew how to do it that way. We had to learn, in the crucible of April 2020.
Yeah. And everybody's worried about like, what's their return to work? And you got like, well, this is it. Yeah. We never had that. We're not returning to anything. That is.
Yeah. We literally had no office. We got rid of our office in June 2020. And so there was nothing to return to. And we now have an office, which has been great, but no one's really wedded to it in a healthy sense. And so we can be more creative.
That's super cool. Yeah. What advice would you share with, and this is unscripted, so this, you and I didn't prep for any of this, but I'm just curious, like, I think we talked earlier at the beginning about the media coverage of fundraising, and it's easy and it's a hot market. What advice would you share? I mean, you shared some good advice about being prepared, having a solid pitch deck and all your material together. What other advice do you share with folks, whether it's, in the YC network or other entrepreneurs that you come into contact with, about fundraising and picking a board and picking investors and all those kinds of things? What any I don't know, lessons learned that you'd share with folks, or things that people shared with you along the way?
Yeah, maybe a process point and then a picking investors point. On the process point, I'm a big believer in game theory. I've studied a lot of it. I do think there are ways to run like an optimal process. Something we didn't touch on, I do think the current fundraising environment leads to a lot of these like suboptimal outcomes where things are moving too fast. You read about this or you hear secondhand these processes break. People ask for too high a valuation, all the firms back out. And so understanding the different negotiating moves in a fundraising process is really important, and controlling that to the extent to which you can control it and driving leverage is huge. That's a big YC thing, and I've taken that to heart. In terms of selecting investors, I think about it in kind of an axis of, best long-term partner as an individual basis and a fund basis. Do these people align with our core values as a company and individually? And then two, what are the deal terms? And this is a transaction and we care a lot about that. And so not losing sight of that and being sort of overly influenced one way or the other with some incredible valuation that you can't grow into, or some incredible person that's like lowballing the terms. You need to find the sort of upright quadrant there and be really honest with yourself of who's gonna, get there and not. And the last thing I would say is I have tried really hard to maintain a great professional reputation. I have been passed on before. We have passed on other investors, and you always try and do that in a way that you feel, if it ever was, brought to light, that you could really stand behind how you handled yourself in those environments. And I wish candidly that more entrepreneurs would do a better job at that. I think VCs have gotten the message on that and the way they handle themselves. I'm not sure entrepreneurs, particularly in this environment, are doing a great job at that.
We can do better. I mean, it's always a hard thing for me, having been a founder and started two companies. And like you said, I had a lot of people that passed on me. Yeah. And I always wanted more feedback. I think that one of the challenges is when you give feedback, it leads to this long conversation. And the reality is we're wrong a lot, right? Yeah. I mean, part of what I try to explain to founders is like, we're going to invest in, 40 companies this year, but we're going to meet 3,000. And of those 3,000, almost every one of them will raise capital. And so we're going to miss the next Figma. We're going to miss the next Airbnb. We're going to miss, but we need to get enough of them right. And I think sometimes as founders, you place a lot of value in that perspective of that investor when their decision criteria may not be. I always assumed it was sort of one-to-one. Oh, if he or she likes me, they'll invest. Yeah. So many other factors at play as to whether somebody can invest in your company. So it's, I think it's good advice. And I guess the other thing I just try to share with folks is you're in the driver's seat. If you're building a good business, you literally get to pick your investors. Mm-hmm. And if you kind of have that Zen, it's like in sports, they talk about Michael Jordan or Tom Brady seeing the field. Mm-hmm. You have that as a founder. You don't feel like you have it because you're rushed and you're stressed and people try to put time pressures on you with exploding term sheets and things like that. But you really are in the driver's seat if you want to be, and you're going to build a good company over the long run. So anyways. Yeah. Rule number one, build a great business and be laser focused on serving your customers. The fundraising follows accordingly. Yeah, completely 100%. Agree. Yeah. Well, look, man, we're excited to be investors. I love hearing the whole story of your I mean, obviously I've heard it before, but I love sharing it with other people, the background and everything else as to why you guys started the business. And I think people are just starting to wake up to how big these vertical opportunities are. So I'm really excited for you and the team. Fantastic. Jeff, thanks for having me on, and thanks for welcoming us to the portfolio. Awesome, man. Thanks.